Hey, welcome back to YT Finance, and today we are talking about how the stock market is going to crash according to 5 major data points that we will discuss in this video. Then we will perform some stock market analysis using Warren Buffett's favorite indicator that says the stock market is due for a correction. And lastly, we will go over why Michael Burry is anticipating the mother of all stock market crashes soon. However, because I am a stock market bull and I am always positive when it comes to the stock market, we will also look at what the top 10 stocks are that Michael Burry is currently buying up and placing call option bets on right now. So stay tuned for that if you want to buy great stocks that are undervalued. Go and press the like button right now on this video for more stock market analysis. Comment down below if you think the stock market will crash or not. Remember to turn on all subscription notifications to stay informed, and now let's get right into today's stories. In the last year and a half, investors have witnessed a historic crash of the stock market where the S&P 500 benchmark dropped 30% in one of the quickest declines on record. However, following that crash, the S&P 500 then had the most impressive recovery ever recorded, and now the index has more than doubled since its lows. But if history has taught us anything, it seems that the market has recovered too quickly to where a major correction, or, according to Michael Burry, the mother of all crashes could be on its way. For the first data point, let's look at how often stock market crashes and stock market corrections occur. Using the S&P 500 index as our benchmark, the market has had 38 drops of at least 10% or more since 1950. These drops have occurred on average every 1.87 years, and right now we are 1.4 years away from the most recent stock market dip. So another dip is fast approaching. However, the problem with this is that we can't use averages to predict the stock market. Otherwise, we would just time the market by using this average of 1.87 years. Now, with that being said, this average does allow us to see the clues of when we could anticipate another crash, even though we will not know the exact timing of the crash. On the bright side, crashes and corrections do not seem to last very long, because the average correction only lasts about 6 months or 188 days, but recently that number has dropped to 155 days based on the newest data available to us. In our next data point, we will look at how the stock market reacts after a crash, which can sometimes cause another crash shortly after. For example, in the previous 8 bear markets dating back to the 1960s, 5 out of the total 8 bear markets bounced back with strong rallies, and 2 out of those 5 rallies experienced another double-digit decline shortly after because the stock market rallied back too quickly, and this is what could be happening in today's market environment. However, the good news is that long-term investors who hold through stock market crashes and corrections will make money in the market regardless of when they initially invested if they hold their positions for more than 20 years. So basically, if you are under the age of 45, you could be investing heavily into the market because at the age of retirement, which is 65, you will still have a positive net outcome if you invested into an indexed ETF, target date fund, or a mutual fund that either matched or outpaced the S&P 500. For the third data point that supports a market crash, the S&P 500 Shiller price-to-earnings ratio, which measures earnings that have been adjusted for inflation over the last decade, is rather concerning. When the Shiller PE ratio is over 30, the index tends to lose 20% or more of its value, and this has held true for the last 4 bear markets. For context, the S&P 500's price-to-earnings ratio last week was 38.58, which is one of the highest it has ever been in the last 20 years. But we should keep in mind that as companies within the S&P 500 trade at higher PE ratios, it will slowly move the average of the Shiller price-to-earnings ratio up, so this could just be the new normal. The fourth data point that we will discuss is the rapidly rising rates of inflation. Earlier this month, the U.S. Bureau of Labor Statistics released inflation rate data, so we can look into this report specifically at the Consumer Price Index for consumer goods and services, which says that inflation has risen over 5% in the last 12 months, which is pretty high. The reason why inflation could be an indicator for an upcoming stock market crash is because during the dot-com bubble, inflation was on the high end of 4%, and then the crash happened. So rising inflation is linked to stock market crashes. However, correlation is not causation. So even though high inflation rates and crashes can happen at the same time, one does not necessarily cause the other to occur. For our last and potentially most telling data point, we have investors borrowing way too much money on margin. Rising margin debts are directly tethered to stock market crashes. For example, margin debt skyrocketed by six-fold back in 1987 when there was a notable stock market crash, and we saw this in many other historical market crashes as well. According to FINRA, in March of 2020, we saw rising margin debts, which went from $400 billion all the way up to $844 billion. The last three times that margin debts jumped over 60%, and in this case over 100%, we had the Great Recession, Black Monday, and the dot-com crash. Even though all these points are true, none of these on their own or even collectively necessarily predict a crash. These are just to be considered warning signs. But according to Warren Buffett's favorite indicator, which he says, and I quote, is probably the best single measure of where valuations stand at any given moment, so this Buffett indicator says that the market is clearly overvalued because this indicator has climbed to 205%. How it works is this indicator adds together every company's market capitalization in the US and divides it by the quarterly GDP to gauge if stocks are overpriced or if they are undervalued. And right now, the indicator clearly says that they are overpriced. Now, I like Warren Buffett, but this indicator is nowhere near perfect. I think there are multiple flaws in this gauge. For instance, it compares the stock market's current market cap to last quarter's gross domestic product. So technically it's always a quarter behind, so it's lagging and not a current statistic. Also, the Federal Reserve has artificially inflated markets and supported companies, which means that has also artificially increased the indicator's percentage. However, Warren Buffett is not alone in predicting a stock market crash or correction, because Michael Burry and the GMO co-founder, along with many economists, think that the stock market will crash, but we will have to wait and see if a crash will actually occur. If you didn't already know, Michael Burry is the chief of Scion Asset Management, which manages more than $2 billion worth of assets, and they specialize in consumer goods, services, and technology. In recent months, Burry has drastically changed his portfolio because since March, he has sold off more than 14 companies, and out of his top 10 holdings, 6 of those holdings are new. However, he has been loading up on technology, shipping, and energy stocks. Michael Burry has an amazing record because his hedge fund over the last 10 years has returned an average of 326%. He is so successful that I want to share with you all his top 10 stocks that he's holding, and if he's right about the stock market crashing, these are going to be great stocks to own. We will start off with number 10, which is held by 15 hedge funds, and the ticker is GEO, the Geo Group. This company is a real estate investment trust based in Florida, which has an extremely high dividend, and because of this, Michael Burry's fund, which is Scion Asset Management, owns 2.5 million shares worth $17.8 million. Next, we have Ovintiv, ticker symbol OVV, and 40 hedge funds own this stock. This is an oil and natural gas company that's headquartered in Colorado, and Scion Asset Management owns 600,000 shares, which is worth $18.8 million. The current stock price is around $26, but the average analyst price target says that the stock should be worth $38 within the next 12 months. In the number 8 position, we have Discovery, ticker symbol DISCA, and 44 hedge funds own this stock. This is a media company that Michael Burry's hedge fund owns, and they own over 855,000 shares worth $24.7 million. The current price is $28 a share, but the average analyst price prediction is $40. Next up, we have CVS Health Corporation, ticker symbol CVS. This company is a Rhode Island-based health service provider, and Scion Asset Management owns over 523,000 shares worth $43.8 million. The stock price is $85 per share, but the average analyst price target is $101. Michael Burry's next big investment was Cardinal Health, ticker symbol CAH, which is a healthcare company. Scion owns over 857,000 shares worth $48.9 million. Their price per share is $52, and analysts think the stock is going to be worth $60 in the next 12 months. In the number 5 spot, we have Walmart, ticker symbol WMT, and 71 hedge funds own this stock. Michael Burry owns call options on 378,600 shares that are worth $53.3 million. Walmart's current price is around $147 per share, but analysts think it should be worth $175 next year. Next, we have the Kraft Heinz company, ticker KHC, which is a food and beverage maker. Scion Asset Management owns call options on over 1.4 million shares worth over $58 million. The current price per share is $35, but analysts have a price prediction of $49. In the number 3 spot, we have McKesson, ticker symbol MCK, which is owned by 51 hedge funds. Michael Burry owns call contracts on 682,400 shares worth $130 million. Analysts think that the stock is worth $261 by this time next year, when the current stock price is around $202. Next up, we have Alphabet Incorporated, ticker symbol GOOG, who owns Google, and 155 hedge funds own this stock. This is a powerhouse internet and technology company in which Scion Asset Management owns call options on 91,900 shares worth $230 million. The current share price is close to $2,915, but analysts value the stock at $3,424. And in the number 1 spot, we have Facebook, ticker symbol FB, which is owned by a mind-blowing 266 hedge funds. Michael Burry owns call options on more than 940,000 shares worth over $327 million. Facebook currently has a share price of $380, but the average analyst price target in the next 12 months is $450 per share. But what do you think? Comment your thoughts down below. Remember to like this video, especially if you made it all the way to the end. Don't forget to turn on all subscription notifications to stay informed, and I will see you in the next YT video.